Hello, good morning, good afternoon, wherever you may be. Welcome to this panel event of the UNEP Global Roundtable on physical risks and adaptation alignment. My name is Paul Smith. I'm a senior climate consultant at UNEP, and I lead the physical risks and adaptation element of our work. Clearly this year, as we're so close now to COP27 in Sharm el-Sheikh in Egypt, is really a key year for looking at this particular part of the climate puzzle around addressing the physical impacts of climate change and adaptation. Last year in Glasgow at COP26, a global goal on adaptation, a framework for that was not quite reached. So a work program to work towards a global goal was set up, known as the Glasgow Sharm Work Program. And of course, over this year, we've continued to have devastating impacts from climate-related disasters. Just one of the major ones were the floods in Pakistan, which killed so many people and devastated much of the country. And this has also led to a rise in discussions in media and between organizations around loss and damage. On the private finance side, a lot of the talk has been around net zero as well and reducing ambitions, but increasingly this year, and particularly at UNEP, we've been hearing a lot more around adaptation. Our own banking board, which is the sort of steering committee of the Principles for Responsible Banking, has requested us as the Secretariat to produce a thought paper around adaptation and to sort of outline some pathways of where we can go as the Principles for Responsible Banking on developing a target setting area for climate adaptation. And also on the investor side, we've recently heard of a consultation paper on adaptation and resilience, which has been released by the Institutional Investors Group on climate change. And hopefully that will inform as well our work with banks and also with investors and insurers on this topic. Today, I'm really happy to welcome four very distinguished speakers in this space. Just there on the bottom left, I have Bouke de Vries, who is the advisor to the board of Rabobank on public affairs and was instrumental in setting up Rabobank's climate program. Also, Bouke is chair of the Green and Sustainable Finance Working Group of the European Association of Cooperative Banks. Secondly, I have Timothy Afful-Koomson, who is Chief Climate Finance Officer at the African Development Bank. Tim has worked for several years for the African Development Bank, integrating climate finance into over 50 infrastructure projects with total climate financing of over $1.8 billion. Prior to that, and partly why Tim is here, he has a history of working in the private sector for over 15 years, working with Merrill Lynch and Navigant Consulting, working on transactions within this space, such as renewable energy, energy efficiency, and forestry. We also have Roehrl from the European Investment Bank. Roman is a climate change specialist, and he leads the integration of physical climate risk in the bank's projects and contributes to the standards, policies, and due diligence procedures of the bank around this very key area. Roman has a history of building resilience in institutions, adapting investment projects, and has worked for the German Development Agency, GIZ, for over 10 years prior to joining the EIB. And finally, Maria Tapia is the program lead on climate finance at the Global Center on Adaptation in Rotterdam. Prior to working for the Global Center, Maria worked at the Inter-American Development Bank as a senior investment officer and lead climate change specialist. And prior to that, and also bringing in that private sector experience, Maria also worked at Standard & Poor's. So let's get into the discussion. And as I introduced you last, Maria, perhaps you can kick off the discussion, because one of the issues around adaptation that we have had from our survey with banks on adaptation and what they are doing around investing in this key area is really defining what is adaptation and whether these framings of adaptation are limiting financing from the private sector. Perhaps you could shape some of the discussions around those definitions. Maria, over to you.
Of course, thank you, Paul. And it does. The framing of what is adaptation is limiting the capacity of financial institutions to increase the share of their portfolios into adaptation investment. And we can see this just by looking at the climate finance landscape. In general, from the climate finance landscape, what it has been tracked, 90% goes to mitigation. And in the climate finance landscape, we are combining what both public and private stakeholders are financing on climate change. And if 90% is going to mitigation, then the problem is wider. It's not a private sector problem, but a general a problem on how to differentiate between what is an adaptation project and what is a development project. There are not enough tools available to assess the effectiveness of an adaptation project. So from a safe point of view, asset managers and asset owners prefer to develop or to invest in development projects rather than saying that this is an adaptation project, because the risk of them of being criticized that if the project has the elements of adaptation, they need to prove the success indicators to say, yes, it's an adaptation project. And because there's, in general, no consensus on adaptation framework, this is only emerging now. For the past 10 years, we have seen an increase of language in development projects when you start including certain adaptation goals or vocabulary that labels adaptation, risk reduction, vulnerability reduction, and resilience, but that is only labeling. We need, and the private sector need standardization and standard frameworks that they can align into saying this is an adaptation activity, this is an adaptation project, and this is how I'm going to be measuring it, and this will be comparable to my competition or to the rest of the financial stakeholder of the market that I operate in. So we've seen that there are a lot of barriers in terms of definition, in terms of investment frameworks, recognized investment frameworks, but also there's a barrier on availability on data that they can have access to start basically supporting the climate rationale of a project, and more international mechanisms that fund adaptation require that the project has additional activities needed, particular for adaptation to climate change. So this has to be very evident within the framing of a project, and it has to have the data to back that climate narrative of why you are saying that that this is an adaptation project. So in a nutshell is, yes, there's a need for a common definition, and again, a definition is not only of what is adaptation, but even at the subsector level and subsector activities, there should be very clear a framework of what is an adaptation and the tools to measure those success and the indicators to report those elements of success.
Thank you so much, Maria. I think that's good framing. What I didn't highlight at the beginning here is that we're having a first round of questions where we look really at the barriers, and then we'll move on to the potential solutions. But I think it's good, Maria, that you've set out those barriers there. And I know that the Global Center, which was set up not so long ago, was it 2017, 2018? Right now is working very closely on particularly vulnerable countries and is working very closely with the African Development Bank. So perhaps now it's a good moment to bring in Tim and just to discuss, in Africa, which is particularly vulnerable to the physical impacts of climate change and is much more of a salient topic than perhaps the emissions question. Why currently are financial flows to increase business and economic resilience to climate change falling short?
Okay, Paul, thank you very much. And let me use the opportunity to say hi to the audience and then also to co-panelists and for UNEP for organizing this. You are right, Paul, that Africa is particularly vulnerable to climate change. And one thing that we sometimes look at is only the resilient capacity of Africa, to adapt to climate change. But there are more than that. And when we look at the fact that several of African countries have some fragility problems, and climate change actually acts as a threat multiplier, which aggravates their fragility and then contributes to violent conflicts and others in Africa, like what we've seen in Burkina Faso recently. It brings to the fore the need to increase climate financing, particularly adaptation financing. And as you rightly know, that this is not the case. It's currently falling short, way below what is actually needed. But the most interesting thing that you need to know, Paul, is that Africa Development Bank is not in that universe of where the climate finance for adaptation is falling. And for example, within the African Development Fund, what we call the ADF window, about 43% of the 2.8 billion that was invested from our internal operations from the ADF window alone, 43%, that is close to about 1.2 billion, went into climate finance. And this is just from July 2020 to December 2021, our operational period. And it will interest you to know that 74% of this climate finance actually went into adaptation-related funding operations, and just 26 to mitigation. So AFDB is telling a different story, than the other investors out there. And why? Because we are in a continent where the vulnerability to climate it's very, very high. So we have to also take that lead. And a lot of the reason why adaptation is currently falling short is that it is not as attractive, as maybe solar or wind, and particularly even to donors. Most of these donors, have companies that are involved in solar and wind, and so it's a very nice way of recycling funding. So funding is provided, and actually you have companies from these countries, lining up for the investment. So it's a very nice way of recycling. For adaptation, particularly community adaptation, you don't have that recycling opportunity. You don't have that certainty of cash flow. You don't have, those investment attraction that will rally private sector, around and behind like a solar or wind. And this is why there is the current gaping, difference between what is needed and what is really financed. Then when you look at climate finance also, particularly even with GCF, right? The challenge for climate rational, and when you look at Africa, availability of reliable, consistent climate data and information is really lacking. GCF, for instance, requires 30 years of point source observation data. Most African countries could not produce this because 30 years ago, some of them are just recording these data in notebooks. So there is no way that a country, like Chad or Lesotho, could produce this. And what happens is that because of that lack of capacity and lack of those data, they are shortchanged on the adaptation finance. And this is what we are seeing all over. And so we really need to rethink how we could, rally around and increase adaptation finance, especially, for vulnerable communities in Africa.
Thank you so much, Tim, and thanks for setting the context in Africa. One thing that you highlighted there was the business case for businesses and for private finance. So perhaps now is an appropriate time to turn to Bouke. Hi, Bouke. What for you would be the barriers to commercial banks developing a business case for adaptation financing?
Yeah, so I would like to echo some of the things that Maria mentioned. So for private financial institutions, this is quite a challenge, because the risk is high, the uncertainty is high, and many of those natural phenomena that we are confronted with are poorly understood. So we're trying to organize ourselves as private financial sector, and we will come to this solution part later on. But I think one of the key challenges that we have to find solutions in is to get ourselves organized on climate data. And I'm not saying there are no data, there are many data, but how can you get the data usable and at a granular level for your institution? That is one of the key challenges. And then we have to measure in the same way. If everyone measures in a different way, we won't be helped in any respect. So we need those methods, we need those standards. And I think we can work on this. So I gladly see others around in this table that we are working with. And I also think that we can find solutions towards bridging the knowledge gap I just referred to. So in short, these are the key challenges that we have to find solutions to.
Well, thanks so much, Bouke. That was short, but very much to the point, and I think reflects a little bit of what we are thinking at UNEP. I mean, we've just launched a module as part of our TCFD program, which is looking at open source data, and trying to work with a few institutions to look at open source data platforms and how they can be perhaps more widely used by private financial institutions. I think there is some already some work ongoing, but what we're trying to do is connect more banks and investors to those platforms, and particularly in, for example, sub-Saharan Africa, where Tim pointed out that there are those data gaps. I think open source data can be of particular use. Some of the platforms we're working with are the World Bank, for example, with OS Climate, and they're trying to develop and leverage funding to improve data sources in some of those areas where it's lacking. Data is, of course, really critical in understanding, what is a foundational element of adaptation. That is understanding the risks from climate impacts. So this is where I'd like to turn to Roman, and just to understand how financial institutions can increase their awareness of physical risks. We've been talking about this since 2017, since the release of the TCFD recommendations. But how are financial institutions approaching this, and how can they improve their assessments and disclosures of physical risks? And the flip side of that would be identifying the opportunities from a changing climate. Over to you, Roman.
Yeah, thanks, Paul, for the question. And let me also say hi to the other panelists and the audience, and thanks for having the EIB today. Yeah, I agree. Data is key, and understanding physical risk in the banking business, in your loan book, is absolutely essential. And have financial institutions solved that puzzle already? I'd say not yet. But you need to ask, can it be solved, right? Can it be solved by the financial sector alone? I think it can be solved, but certainly not by the financial sector alone. I think I'm echoing some of the points that the other speakers have done already. I think there are a lot of really useful initiatives on the way in the adaptation space, especially in the recent years. I think there's been a tremendous momentum, including in the financial sector, but not only there. Let me give you some examples. So the MDBs and increasingly many public and also commercial banks have started to assess their projects and their loan books against physical risks. And we see new climate services on the market and also in the public space that haven't been available in the past. We see rating agencies and big consultancies to start offering these services, buying up smaller boutique companies. So this is moving out of the, esoteric niche sector that it has been. I don't know, when I was still back at the university, and it's really becoming a mainstream service offering. That is really great to see. It's still at the beginning, but I think it will go a very long way if we look back at today in a couple of years. There are super important public disclosure initiatives that have started off as a voluntary initiative, but they are becoming increasingly mainstream, and I guess they will eventually become translated into some form of law, at least in some areas of the global market. For example, TCFD reports have been mentioned. They're extremely useful for us at the EIB as an investor, and I think for others as well. And we look forward to seeing more and more of these reports being published. Similar thing for the Carbon Disclosure Project, which is originally about mitigation, but it also covers physical climate risk. And more corporates are including physical risk in their CDP disclosures. For us, it's very useful, and every individual data point allows you to have a more aggregate data set, which has its own use again for mainstreaming physical climate risk into a broader bank portfolio. There's the taxonomy in the EU, and regulators have started stress testing with environmental and climate risks in mind. So there's a lot going on. But to be very clear, that's useful, but it doesn't do the whole trick for us. We still need to rethink completely how we do infrastructure from the outset, how we do networks, supply chains, access to market, etc., in a very fundamental way. That's what adaptation is really about. It doesn't start with an investment opportunity that arrives with a loan officer in a bank. If that hasn't been done, if your investment or your project's been based on data, on engineering practice, and on regulation and standards that hasn't been updated to take future climate change into account, you don't know. As a bank, you don't know what you're looking at and how your investment will perform over decades. For EIB, as a long-term investor, that's a huge problem, and we've been communicating around this. It's a society problem. It's a huge problem for society, and it needs to be solved on many levels before it can, be fully considered solved in the financial space as well. So a lot going on, but we're not quite there yet, and we need to keep up the momentum on this one.
Thank you, Roman. And to add to those public disclosure initiatives, I think we should also add the IFRS International Sustainability Standards Board principles. So, I mean, they do integrate physical risks and have appendices that cover the different physical hazards. There's also work underway throughout the globe. I mean, most notably the SEC is trying to implement disclosure. There are disclosure rule in the United States, which would be a major step forward. But very good to highlight those, but also to highlight that they are necessary but not sufficient. And perhaps more so than emissions reductions around adaptation, we need more collaboration. I think that's a very key part of the puzzle as well. I think talking about problems can be quite easy, but I think what we want to hear and what the audience wants to hear is how are we tackling some of these barriers, and what are the solutions. And as we stepped off Roman's discussion on collaboration, I think it would be a good moment to go back to Bouke, because in the Netherlands, there's been a long history of collaboration around natural catastrophes and responding to climate impacts. And Dutch banks have been at the forefront of this, particularly around key retail sectors such as agriculture and real estate, which perhaps you could tell us a little more about, Bouke. So what lessons do you have for other countries and other banks in driving economic and financial resilience?
Yeah, so I'll get into those two examples in a minute. But I think one of the first lessons is that we need to connect. So we need to connect industry to finance, and we need to connect to the government. We need to connect to knowledge partners. And the Netherlands has found a way, I have to say, to organize this discussion around climate risk and around climate adaptation in a national platform on sustainable finance, which is hosted by our Dutch central bank. And all representative organizations from the financial sector discuss with the ministries and the central bank how to get ourselves organized on this topic. A lot of progress has already been made around how to get to net zero. And I think we still need to deliver on all of those approaches. Don't get me wrong. But at least we organized ourselves to get the agenda clear. And we need to do the same around the climate adaptation topic. And we started a new initiative in this group. An insurer took the initiative, and Rabobank has joined it together with the other large banks. And we will work on this for 1 year to get the available information and data and knowledge usable for financial institutions. And that's completely a different thing, because we have approximately 800,000 business clients in our bank, roughly 8 million private clients. And you have to translate all this information into something that they can work with. It should allow for an opportunity for a business to prepare to adapt, or should be translated into a risk premium to incentivize clients to take measures. It has to be made specific. And that is one of the lessons we learned, that you need all those parties. You need to have a central platform to discuss it. And then I'll turn to the two examples of the real estate sector and agriculture. On the real estate sector, for example, we have a Delta commissioner in our country, appointed by the government, and the GCA is aware of this. But his sole task is to keep our country safe from natural disasters. And of course, flood risk is one of them. It's not the only one, but there are several of those key natural risks that we want to keep our country safe with. We translate those ideas and this information into how can we increase climate adaptive building. So if you build a new infrastructure project, if you put a new real estate, you have to know what are exactly those types of physical risks over different time horizons. So this is not new to all of us. Many of us are working on this already, but I think what is new is to make sure that you have a national agenda and to fully tap into the potential of accessing private finance, but also about maintaining stability. And so those are risks that can have quite a substantial impact. So I'll get that. I'll cover this topic with more respect. The other example is on agriculture. It is the climate smart agriculture. I think we have to take account of much more salinization due to the difference in water sea level and our low-lying country. It will mean that salinization will increase, and this is detrimental to agriculture. And so we're taking account of that risk of salinization. And internationally, and then I'll round off, Rabobank also works in 39 other countries in the world. And we team up with the global partners also to make sure that cooperatives can be part of the solution in Africa and Latin America. And so we see that there is a way to get the financial sector more organized around this topic at the producer cooperatives level in agriculture, but also at the financial cooperatives level. So those two examples and a lesson from our country that has to deal with flood risk for ages. I would like to share with you.
Yeah, I mean, there's some good lessons there, Bouke, and of course it's still a challenge. 8 million customers. I mean, that's a major challenge, but at least you're showing the way forward and that something can be done. Yeah. So, how might some of those lessons apply in Africa? And I mean, Tim, you highlighted the fact that you've managed to channel so much of your climate finance towards adaptation. What kind of financing approaches and financing solutions are you looking at in Africa? And do you have any good examples of bringing in the private sector as well? Tim, you're on mute. You just take yourself off mute. There you go.
Okay. Thank you very much, Paul. Can you hear me now? Hello, Paul. Can you hear me?
So I was giving a thumbs up, but yes, we can hear you.
Okay. Yeah. Cool. So you are right. That innovative financing solution is very, very critical. Before I come to that, I would like to address this issue about availability of open source climate data. It is right, but experience presents a different real situation than the assumption that, oh yes, I mean there is open source climate data available. African Development Bank had a very unfortunate experience of tapping into some of these open source climate data, like the Climate Research Institute, the CRU data source, because both IPCC and WMO has recommended that in the absence of point source observation data, CRU could be used. So we used it for one of our funding, proposals for one of our climate finance instrument that we are, pursuing, and it was rejected. That open source data was rejected. So the assumption that it's available and the reality is quite different. This is where I want to, point that we shouldn't assume that because it's available, then all climate finance, are accepting that could be used to justify the vulnerability and then also the necessary interventions that have to take place. Now, on the area of innovative financing mechanisms, that there are several financing mechanisms that are going on. AFDB has been involved in the Africa Climate Resilient Infrastructure Network. We've also been involved in the Africa Climate Resilient Investment Facility, together with World Bank, ECA, and African Union Commission. And Ifrs was actually capitalized, by the Nordic Development Fund. And there are other innovative solutions like the Coalition for Climate Resilient Investors, with membership that, bring to the table over 20 trillion in assets under management, which is very significant. Now, most of these initiatives are more focusing on climate resilient infrastructure and not the other areas like community adaptation and all that. AFDB itself has this adaptation benefit mechanism. It's a very innovative financing mechanism for mobilizing new and additional both public and private sector finance to enhance climate change adaptation. And the risk, and then also provide some incentive to help facilitate payment for delivery of adaptation benefits, like adaptation benefit certificate, where it could be used to present for the incremental cost of generating that benefit. And certainly for investors, it's something that makes them see that they are also contributing to adaptation finance, particularly at the community level, which is really critical, and do not have the private sector investor interest. For adaptation activities, on a community level, because it is really underfunded, we also have to rethink, some of the innovative financing mechanism and how we could, adapt it to the community level. Some pooled resources like the green bonds and green notes, where investment from private sector, institutional investors, endowment foundations, private investors are really put together for facility, could be useful if it is backed by more highly concessional, terms, unlike what we've been seeing in the green bond space. Because, as you know, a lot of these community-based and ecosystem-based adaptation measures do not have any certainty of cash flow. So having those financing terms will be a big challenge, for such financing. For the infrastructure level, I mean, those, yes, but for the community base, there will be a challenge. There are also other financing instruments that we are looking at, or adapting, something like the tax equity investment, where companies that will not necessarily invest in adaptation could put their investment in, have some ownership in that transaction, and then they use their taxes, the tax exemption, to defray those costs. And once those costs is attained, the level of those costs is attained, the investment ownership flip back to the community. And these are some of the innovative ways that we could use to both catalyze private sector financing and also provide some resources for particularly community and ecosystem-based adaptation that are not so attractive investment-wise. And then setting up some facilities like technical assistance facilities, for TA advisory services, for doing climate science analysis, so that African countries could tap into climate finance. And as I indicated, there are some open source data that are not really accepted by some of the climate finance instruments out there. So this TA could help to really look at point source observation data and how to prepare these countries way forward. At least if they will not even have available 30 years, the trajectory could be charted for improved gathering and dissemination of climate finance, that in 20 years' time, most of these countries, will be in a better position to provide credible, consistent, reliable point source data. Thank you.
Thanks so much, Tim. Point taken on open source data. That's why we need to work on it and improve from here. Just to note, we don't have so much time left. I'm going to turn to Roman and Maria, but perhaps just very short answers, unfortunately, a couple of minutes. We've heard a little bit there from Tim about the role of development banks and concessional financing. Roman, how does the EIB fit into that puzzle, and how is your strategy responding to financing adaptation?
So you can read all about it in the EIB's very first adaptation plan that we launched last year. Just a few highlights. So there's a dedicated target now. We try to increase the EIB adaptation finance by the factor 3 by 2025. So a trebling of adaptation finance. This will be very challenging for all the reasons we discussed already today. Standards, how to define adaptation, etc., engineering practice. At the end, we are facing a problem of an empty project pipeline, right? EIB is not rejecting projects that come with an adaptation motivation. It's more the lack of these projects. If we would get more, we would be able to finance more. So our adaptation plan is really trying to address the pipeline problem through a number of initiatives. As Tim said, we will also increase our adaptation targeted technical assistance, advisory services, especially for countries outside of the EU, in Africa, small island development states, and LDCs. We've also decided to take on more risk for adaptation projects specifically. The bank has traditionally financed up to 50%, but for adaptation projects in small island development states and in LDCs, we will go up to financing 100% so that the projects can go ahead and shall not be delayed by a need to find other finances. We will also address the data problem. We will work with the Copernicus program in the EU to make, with our expertise as a bank, combined with the supercomputers, the climate scientists over there, we will try to process that data in a better way so it becomes available for investment decisions for our clients, and make sense at the local level. So that's a similar issue like the open data point that was done earlier. And we are engaging in more partnerships, including with the African Development Bank and the Global Center for Adaptation on the Africa Adaptation Acceleration Program, and many more to cover. So yeah, the adaptation plan for us it's a huge step. It's a big commitment to push up the agenda adaptation. I'll stop here. Thank you.
Thanks, Roman. And there's so much to pack in there, and I'm sure if you go onto the IB's website and see the strategy, you'll have some more answers. Great to hear about your collaboration with Copernicus to develop open source data. So really, really looking forward to what comes out of that. Maria, finally to you. Sorry, we have so little time left, but as GCA is the real you have a real hub there around adaptation, and in your convening role, how do we bring all these strands together? How do we increase collaboration between the private sector, between commercial financial actors, multilateral development banks, and policymakers, including regulators and central banks? How can we bring them together to unlock the door to greater adaptation financing?
Okay, so I'm going to echo what Bouke said. We have to bring together the public and the private, the industry, financial, and the government together. And adaptation itself it's a local problem, so it requires local action. So having these platforms of sustainable finance at the country level, led by either the central bank or the Ministry of Finance, to move the agenda forward, this is a way to do it. It has been very successful in the Netherlands and in other countries in Europe, but also in Latin America. We have experience in Chile of a sustainable finance platform led by the Ministry of Finance and bringing together industry and financial practitioners. So that's a way to do it. Then the MDBs will come in to support those country initiatives. And I do congratulate a lot EIB and AFDB on their ambition on adaptation. We have been working with both institutions to increase their ambition. But these are kind of examples where when the country organizes itself and then go and reach the MDB institutions, it's easier to get the financing that is needed to deploy a series of activity and capacity building at the country level with very clear objectives and very clear outcomes. So this is a way to do it, and it's not a secret. It's working, and so I hope that by other countries come together as country with their different stakeholders, public and private, together, and then bring a partner or several partners, institutional partners, to help them deploy the agenda.
Thank you so much, Maria. You went right up to the wire there. But thank you to all of you, Maria, Tim, Roman, Bouke, and my alarm's going off as well. Thank you so much all for joining us today, and what a great discussion. And hope to see you again. Thank you so much.
And thank you, Paul. Thank you, colleagues. Bye-bye.
Bye.
Thank you very much.